All right, welcome back. Part 2 with Dr. Craig Kaplan. Awesome. I'm excited for this one. I know in the last conversation, we wanted to talk a lot about, well, we didn't just even have enough time, and we had to gloss over like actually a really huge portion of your career, and that was kind of the animal spirits and the predict Wall Street phase of your, how many years was that for you?
14 probably. More than that, but 14 running the company. Yep.
You got the scars to prove it. Well done, sir. I wanted to see if we could do a little bit of a deep dive into that. It's a really kind of fascinating kind of premise for me. Crowd intelligence is particularly interesting to me. I don't know if you've heard the same story. Do you remember hearing like they found a journal from like a carnival in the 1800s that had one of the games where they had like a jar full of jelly beans and they had everybody guessing how many jelly beans, and everyone was off by orders of magnitude individually, but when they averaged out all of the guesses in that book from like 100 years ago, the actual guess from the crowd was off by like 5 jelly beans. So fascinatingly accurate.
Right.
And I deal with developers in data science, and one of the most common GitHub repos that they have in their portfolios is, hey, we're going to basically predict Wall Street using social signals or whatever else. And for me, it's one of those, I'm like, I've seen a lot of people try to do it. I haven't heard of many that actually were able to pull it off. So with much ado, I'd love to hear about your experience and how you built it and what worked, what didn't, and how you came to that conclusion.
Sure. Well, Dan, great to be back with you. Well, let's start there with some people may remember this was a while ago, more than a decade ago. James Suryecki, who I think he wrote a book called The Wisdom of Crowds. Mm-hmm. And it sort of talked about some of the things you just mentioned, that in times past, guess the number of jelly beans in a jar or the weight of an ox. They'd put the ox out there and everybody gathers at the fair and submits their guesses. And the amazing thing that he found, and that's where the phrase wisdom of crowds comes from, is that even though any one individual might not be that accurate, if you took sort of the average of all the guesses, it was amazingly accurate. And so this phenomenon sort of became known as the wisdom of crowds. He wrote an entire book about it. In that book, there was actually a chapter on the stock market. Mm-hmm. That book came out after we had done our research, because I remember realizing, wow, here's another guy who understands what we just presented at this conference or whatever. So we were a couple of years ahead of that book. But nevertheless, that kind of caught the popular imagination. And there was a time when, so if we zoom out, here's how I think of it. Mm-hmm. That notion of the wisdom of crowds is a subset of a larger idea and a larger research field actually called collective intelligence. So collective intelligence is just the idea that many minds are better than one. And so one way that could manifest is sort of guessing the weight of the ox or the jelly beans, or you could build systems that are collective intelligence systems that sort of try to give you an edge in Wall Street, which is, I guess, what we're going to talk about today. Certainly there's prediction markets, probably lots of people are familiar with. That is also an example of collective intelligence where you're actually using a market mechanism to sort of process the information. And I guess I'll start with, when I began doing this, the very first prototypes for this idea, I think, was around 1999. We presented some research in 2001. So this is 5 years before we started the company. There was a global brain conference in Brussels where we presented a prototype of the system that became Predict Wall Street. And we were kind of lucky. We built a system, it gathered input. We didn't have that many people giving us input, but it beat the market by this huge amount that was statistically significant. And I knew nothing about Wall Street at the time. I was coming at it really as, let's find a problem that's very difficult, that has a clear scorecard. And I knew Wall Street was highly competitive. It attracted the best and the brightest from everywhere. Scientists that normally would have gone into, physics and cosmology, they were lured over to these quant funds by the promise of big bucks, which they made. And I thought, wow, if you could play in that arena, that's got to be about as competitive as an environment as there is. And at the same time, there's this very clear scorecard. You either win or you lose. It's very clear. The price went up and you said it would. Okay, you made money. You can quantify how much you made. So it seemed like an ideal environment to test ideas on collective intelligence. And that's how I got into it. I knew nothing about financial markets at the beginning. We had this, what perhaps was lucky prototype that happened to sort of do really well. In retrospect, the market had some giant moves and we happened to be on the right side of those moves, but those moves were not necessarily typical of normal market behavior. But we ran the experiment for just a week or two. And during that week, it did amazingly. So we thought, okay, we're going to, put consulting on the side. We're going to go raise venture capital. We're going to build a company. And so that became Predict Wall Street. It had some angel backing between 2001, a lot of it from me and friends of mine. But then in 2006, we sort of brought in the VCs and, the real, not institutional money, but the smart money. They say they're the smart money.
Yeah. What signals did they have in 1999 that you could select from?
So the naive idea back in 1999 was the following. We're going to take average people that were not Wall Street pros. In fact, the sample that we took from was, I just went to a local charity that had people cleaning up the beaches because, I live in a beach town. And I happened to know the guy who was in charge of this charity. And I said, if we donate to your charity, would you get all your members to come on a site and give us their stock predictions? And he said, yeah, we do that for charity. So that's Save Our Shores was the organization. And so that's how that worked. So these were people with no special knowledge other than they cared about the ocean. And we asked them originally to kind of put in their predictions a price target for various stocks. And our theory was, if we track them over time, it's what I would call now, I describe it as the needle in the haystack approach. So there's various forms of collective intelligence. It's not always that you average everybody's opinion. That's one way to harness collective intelligence. Another way to do it is you're taking advantage of the broad reach over the internet and a lot of people. And you're saying, somewhere out there is the next Warren Buffett. Most of the guys don't know what they're talking about, but there's probably somebody who does. And if we could just identify that, if we could find the needle in the haystack, we could just kind of key into that person's input and that would sort of work. So it is collective intelligence, but it's more of a filtering thing rather than an averaging thing. So there's a variety of different mechanisms. So we did needle in the haystack at the beginning. We actually filed a patent on this, where basically you compiled a track record on everybody and you kept track of who did better than chance. Anybody at chance, you just sort of ignored them. Anybody who was consistently wrong, you flipped it and you did the opposite of what they said. And anybody who was consistently right, you gave them a weight on how good they were and you would follow them. And you would combine statistically all that information and that would give you a trading signal and you go. And that seemed to work in the prototype. As I said, we had a little bit of luck involved because just the market period that we tested it in. But the good news, and sometimes this is the way stuff happens, is if you knew everything that you know now, you never would have done it, right? And that's kind of how this was. In fact, all of the experienced mentors that I talked to at the time, my advisor had a Nobel Prize in economics in grad school. I had graduated, and been out in the real world for 10 years or something. But I flew back and met with them. We had a glass of wine and I explained this idea. And he said, Craig, I hate to rain on your parade, but markets are very efficient. And maybe it'll work, but you're bucking the odds here. And I had another mentor who grew up in the Depression, very successful, had advised lots of companies, founded the entrepreneurship program at UC Berkeley. He said, this is never going to work. You're a promising young man. You should go do something else. Don't waste your life on this. So I got a lot of that kind of stuff from, people that were not dumb. These were really smart, respected people. But I just sort of really believed in it and wanted to try it anyway. And I thought I had this great data that sort of proved them all wrong, which was only partially true. So later I learned a lot more about Wall Street and realized that, wow, we really had a little bit of luck and some other things. And had I known that it would take 14 years, I probably never would have embarked, because we thought we're going to do this for 2 years. We're going to sell this company. We're going to be rich, drinking martinis on the beach and on to the next thing, right? And, life doesn't always work.
How could we not? How could we not?
How could we not? So that was kind of the early days. And that initial success was based on sort of needle in a haystack. But it turns out that there's other forms. So quant funds and Wall Street are doing all kinds of things. Some of them, you and I were talking a little bit before the show about sentiment analysis. Basically, you're looking at the words in press releases, or you're looking at news things that are coming out, and every time it's a positive word, it gets an extra point.
Sure.
Microsoft had terrific earnings. Oh, terrific. Yeah. The word terrific, that's worth 2 points on sentiment or something when it comes next to earnings. And so there's these kind of automated analyses, and they're very, very, very smart people. I mean, one thing that I learned that I did not know at the beginning is most investors have no idea who they're up against. They are up against amazing people with amazing resources. Not only are these hedge funds, these quant funds, the top quant funds, and I've met many of them, not only are they incredibly smart, they have huge resources. Yeah. The average retail investor has no chance of outsmarting these guys because, I mean, the average retail investor, I'll use my dad as an example, or most of the people I know, they get a newsletter, an investment newsletter, or they watch CNBC, and they say, oh boy, we're going to jump in on this stock because, now I understand. No, the quant funds have spent $10 million a month getting every data feed from every source, and they're analyzing it at the speed of light with the sentiment analysis and every other kind of thing, and they're producing complicated signals, and they have computers that literally require your own PG&E power station to run. I mean, they have to have a substation on their site because there's so many computers that are stacked floor to ceiling, and they're crunching numbers 24/7 and doing simulations. And the average person who watches CNBC is up against these guys in the market, but they have no idea that that's who they're up against. So it is a very tough game. And it is, in retrospect, amazing that we were able to do what we were able to do. But it turns out, and here's really part of the answer that it worked in this particular domain. The particular thing we did was we asked retail investors what they thought about a stock. And once we launched Predict Wall Street, had the venture funding, I was on an airplane flying around and talking to different brokerages like TD Ameritrade and Schwab and NASDAQ. And we were partners with all these guys. And I said, look, we'll build this technology, but we want to put it on your site. We don't want the users. We want all the users to stay on TD Ameritrade or Schwab. And we're just going to be a service to you. And maybe you pay us a little bit of money because, we always needed money. But we're not going to charge you a lot. And every time somebody does a quote lookup, which is the most common thing that people do, I think Yahoo Finance at the time had over 2 billion quote lookups per day, 2 billion a day, just quote lookups. Wow. What's Apple's stock price, whatever. And TD Ameritrade and all the sites, that was the most common thing that anyone would do, because before you place a trade, you need to know what the stock price is. So you put in the ticker, up would come the quote, and there would be a graph typically. And we said, please just give us a fraction of an inch of site space underneath the graph where we'll put in our widget, and our widget will be this little poll, and it'll say, do you think, if the graph was on Apple, it would say, do you think Apple is going to go up or down tomorrow, the next day, a week from now? We'd have these different time frames. And instead of making people put in a number, which was too much work, you lose like 80% of your users immediately if you make them type anything. Just make it easy. They click a mouse, an up arrow or a down arrow. Right. And people would do that because we would show them what everybody else thought in the community after they told us their opinion, which was reasonable because we don't want to bias you. Everybody understands that. And it was like, everybody said, well, shoot, I'll share my opinion because I'm guessing anyway. I'll just click up and let me see what everybody else is thinking. Because, you're about to make a trade in Apple, so you're highly motivated. It's like hitting you right at the right moment. And now I get to see what everybody else on the TD Ameritrade community, but not only on the TD Ameritrade community, because we had partnerships with Zacks and all kinds of people. So you get all of that, and we crunch all those numbers together, and we give you the poll results from everybody. And we didn't say that they were right or wrong. In fact, we had a disclaimer. This is just a poll result. We are not investment advisors or anything like that. We're just giving you information that maybe you're curious. And people are curious, and they would do that. Okay, so now if you zoom back and you say, now what are we getting? We are getting somebody's opinion before they trade. Because psychologically, if you think about it, so the reason my Nobel Prize winning advisor in grad school and the business mentor and everybody else said this is never going to work is they say markets are highly efficient. And they're right. Markets are highly efficient. They're very efficient at processing all available information. But the way that they process that information is somebody places a trade, right? You place a trade, I place a trade. That's what a market does. A market, in a way, is an information processing mechanism. You say buy, I say sell. It's okay. You think something, I think so. And it figures out in a numerical way how to weight that information. And it's very efficient at doing that. And to get an edge on that is very difficult. There are lots of quant funds, I will tell you, I don't know, big secret, that buy order flow. They pay brokerages to just see what the retail guys are trading. They pay them a lot of money what they're trading. And they use that information with their complicated models to then have trading signals. And that's another reason why the retail person has no chance of beating these guys, because you don't have $100 million to pay 10 brokers to find out every trade that retail guys are placing and then crunch the numbers on that and then figure out how you take advantage of it. But we weren't doing that. We weren't asking, what trade did you make? We were asking what you thought. Did you think it was going to go up or down tomorrow or a week from now? You may not have traded at all. In fact, psychologically, it's a known fact for those who study these things that humans don't like to sell losing positions. The pros are supposed to be good at this, and even they're bad at it. But retail people, you could ask them, is Google going up or down? And they could say down. And then if you ask them, because we did these interviews, have you sold Google? Oh, no, I haven't sold it. I know it's going down, but I don't want to sell it because I don't want to take the pain, right? So you could actually pick up information from what they were telling you because that information was hidden. The only place it existed was in their heads, right? It didn't exist in the market. None of those other quant funds could access it. So we actually, this tiny little company in Santa Cruz, California, had an edge over these huge quant funds in New York that had, 1,000 times more budget than us or more. And the room's full of computers. We're running on PCs. Because we came up with a more clever way of accessing the type of information that was locked away in a million individual brains. And we just asked for it. And they would give it to us because we told them what a million other brains were thinking.
Did you tie it into a feedback loop? Was there an additional, because oftentimes did they ever go, okay, cool, up, down, see if they actually do a trade after that, or see if they reverse the trade or contradict their own prediction after they're exposed to the subsequent information?
We would like to have done that, and we tried to do that, but it turns out that the brokers and our partners are highly protective. They would not tell us what people are trading. They would give us only the bare minimum amount of information that we needed to aggregate the results and give it back to them. They said, okay, we understand you need that because otherwise you can't give back what you're promising. So we'll let you do that, but we're giving you nothing else. And by the way, it all has to be anonymous. You can't identify. I mean, everybody was there's all kinds of hurdles on compliance. My gosh. I mean, I spent a lot of time talking to compliance people and reassuring them.
No forward-looking statements, right? Don't use the word can. It's like, no. Yeah.
But we knew from our own experiments and then later, from our own trading, and we fully disclosed that, we can use this information to trade. And we're also very careful. There was a time when we would give some signals. So you can give raw poll results back to a retail person. They put in their opinion. You show them the results of the poll. Nothing wrong with that. There's no implied trade there. We had something more advanced than that, where we actually processed it and turned it into a trading signal. And because kind of the vision of the company was we like the little guy having a chance against Wall Street, which I just described. You have no chance. So we thought, how do we give the little guy an edge? Let's carve out some signals that we don't use and that we don't give to anybody else. We only give them to the retail guys. And so that would be an additional bonus because those things actually made money. But of course, we didn't promise that they would or anything like that. But we actually gave them. And then if they were on that list, then they were filtered out of anything that we could use or other people. So it was just for the retail guys. And we know that those made money. So we know that Ameritrade clients who traded on those, if they trade it in a very simple way, like buy at the open, sell at the close, they would have made money.
Clarify for me because when they make money, they're doing customer predictions and things like that. But help me understand, because when they make money, oftentimes, I'll tell them like, look, if you can get a few percentage points, you can buy an island.
Yeah.
And they usually go, no, I'm going to give you 1,000 prospects. I want you to pick the customers and I want them all to be right. I'm like, that's not how it works. When you say like, hey, we're making money, what type of numbers and predictions directionally are we discussing and dealing with?
So the way that we did the accounting on this, and what I think is a fair way, is we sort of said, we're giving a signal, it's for like a day time frame.
Sure.
So the way we're going to model it is you buy it, if the buy signal, it comes out before market open, so it's forward looking. If it says buy Apple, then we're going to model you bought it at the open, and it's a short-term signal, because a lot of our signals were short-term, and you sold it at the close. So it was a one-day thing. You got the opening price, you got the closing price, and then, just calculate the difference. And, did you make it or lose it? Now, in those days, there were commissions, so you would have to subtract commissions. Even after subtracting commissions, you made money on these things. Mm-hmm. But it was something that would be useful for a retail investor, because retail investors are trading relatively small quantities. Mm-hmm. As we got more sophisticated into the hedge fund world and everything, and had hedge fund clients and so forth, they really care about how much money, market impact. There's a whole lot of things that are unique to Wall Street that I had no clue about, that I learned a lot about, and I now know. And one of them is, the more money you try to put in on stock, the more you're going to move the price. So you can give somebody a signal, buy at the open, sell at the close, and it works. And then as more and more people jump onto that, it stops working. The alpha or the edge gets eroded away, right? It's just a natural thing. All the hedge funds know this. It's true not only of our thing, it's true of any signal that you have. If other people have the same information as you and they're trading on it, then that edge goes away. And it's one of the reasons why my Nobel Prize winning advisor, who's so much wiser than me, said, this is a really hard problem. It's tough to do this. Well, because every time, even if you can get an edge, the edge doesn't last very long. The half-life on those things goes away. Yeah. And we saw that too. As people began catching on to what we were doing, we had huge amounts of profit off this thing in the first couple of years. And over time, it went down, 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 because people were figuring it out and they're doing their own versions. Yeah. So that's one way to do it, is to sort of try to find the needle in the haystack where you're giving weight to it. Another way to do it is to take the average, the wisdom of crowns guessing the jelly bean. And then it turns out that there's all kinds of very subtle things that can make the difference between being profitable or not. For example, many retail investors overreact. We found that. In fact, that's what the Wall Street guys told us all the time. We can't believe that the retail guys, this is their words, not mine. So no one should take offense. Go ahead. But you and I, as retail investors, we are considered dumb money. Okay. Sure. That's what those Wall Street guys look down on us, and they say, you're the dumb money. We're the smart money. They said, there's no way the dumb money can be right on this. If a lot of dumb guys all say the same thing, you have the average of dumb guys and you're not going to make money. And that can be true. It gets subtle. It can be true, but there's other situations where it may not be true. But it's also true that even when that's the case, and the retail guys, you and I, watch Mad Money on TV and we get excited, and Jim Cramer recommends this and we check it out, and my dad gets in there and says, oh, the newsletter, I'm buying. And we get irrationally exuberant, to use Greenspan's term. That shows up in our data. It showed up in the Predict Wall Street data, and we'd say, wow, that's a big standard deviation move in sentiment. And we would see that before the trades hit, and we'd say that's going to regress towards the mean. That can't last. People are overly optimistic. It's going to come back to reality in a certain time period. And, there's devil's in the detail. You have to know the time period. You have to know all these things. But then you can measure that and you can trade off that, right? And it's kind of the same idea. If somebody's consistently right, you can follow them. If they're consistently wrong, you do the opposite. Both ways make you money. The key is consistency. Consistency means there's actual information. There's actually alpha, which is just another name for information that is not widely disseminated in the market. That's really what you're in. You're in an information processing environment, which brings me all the way back to collective intelligence. That is what collective intelligence is about, processing information.
Interesting. You've reminded me that there's an inverse following trade on Jim Cramer right now that actually outperforms the market quite well. And it's one of those where I'm thinking now, I'm going, wait, is it because he's right? Or is it because the dumb money's following him, then basically canceling out his trade? And therefore, but like supposedly the inverse follow of Jim Cramer works quite well for people.
Yeah, you got to be careful with that because so much of it, as in life in general, is timing. So it may very well be that Kramer says something. And by the way, I like him. He's a good guy. I've met him once at a conference that he probably doesn't remember, but I think his heart's in the right place. He is trying to educate and he, generally I feel like he's one of the good guys, but nevertheless, people can get very excited, overexcited, irrationally so, maybe in a short time horizon, and it will regress. So you could make money on a short-term trade, but if you took a longer time horizon and he's actually giving good advice, then maybe you don't want to do the opposite. Maybe you do want to follow. So you have to be very careful, and you can't, certainly I hope nobody listening to this takes this is not investment advice. And something that I learned over the years is this is a lot more complicated than I thought when I started. I thought this is easy, especially the first couple of years because we were doing so well. We had investors saying, we want to give you more money. And I said, well, I don't know that this can last, They said, well, no. I mean, it was just greed. They were like, we want more. And I said, well, you got to be careful. And so, yes, it doesn't always last. And there's all kinds of factors that make this complicated.
Huh. So when you were doing it, I mean, because obviously you made money off of selling the data itself, right?
We did eventually. We wanted to resist that actually. We had the vision that we wanted to become hedge fund managers ourselves. Why should we sell the data to somebody else? We should just use it. And also it was it went against the grain. Our whole thing was, we were championing the little guy, like the retail guy. We wanted the retail guy to win. And we liked the idea of giving the retail guy lots of good signals and not giving them to, hedge funds. Because we felt like, at least naively at the beginning, they're the enemy. But as you're running the company and you have employees and you're running low on cash, you start looking at things that you hadn't planned to do in the beginning in order to keep the lights on. So we did end up doing that at some point.
Gotcha.
But not the signals that we gave them. We were careful to carve those out, just to be clear.
Okay.
Yeah. Gotcha. So we never compromised on that. If we were giving something to the retail guys, we kept it for them.
Do you still follow the space and premise like poly markets and things like that? I mean, there's a ton of these where I'm going like, man, like the sentiment and the things that you're talking about, for me, they get almost exacerbated when you're talking about like crypto. I've always been like, crypto is a social capital. Like it's all animal spirits, in my opinion, my personal opinion.
That's right. Yeah.
When you see and follow those, do you continue to kind of trade follow? Which ones do you kind of pay attention to? Which ones are the interesting kind of approaches that have kind of struck you as just uniquely interesting, whether or not they work?
So I have some experience in the crypto markets. I don't trade them or day trade them myself. And I can say that definitely they are driven by sentiment to a large degree. So there's some things, if you have a, kind of boring blue chip company that makes toilet paper or something, you know what? It tends not to have the same kind of meme stock, appeal as GameStop or, Bitcoin or Ethereum or even, Dogecoin. So, it's toilet paper. And so it tends to trade more on the fundamentals. Are they making money selling toilet paper? If they are, then it's a good stock, right? That's the kind that Warren Buffett likes, right? Coca-Cola, cheeseburgers, and See's candy. Like, let's not mess around with this craziness.
Yep.
But the more crazy something is, the more sentiment is going to be driving the price action, and the more some kind of approach like what we did, where we're tapping retail investor sentiment, is going to potentially give you an edge. I would say that.
You talked earlier about the regression of the mean, and that's one of the approaches that I've heard a lot of people doing, where they're like, okay, again, we track the notion, and the markets are efficient in terms of trading high speed. But the trickling through the population is not necessarily, like to your point, we see it, there's an outsized disproportionate response from the retail investor. And then as it regresses to the mean, I've seen a lot of people that are going, hey, I can track that and I can trade. And and basically use kind of the equivalent of high-speed trading, but using sentiment and going, okay, it has to roll through the markets. And there's oftentimes the people that roll through. We mentioned like crossing the chasm, where you have like, you can almost even watch the innovators, people that are the closest, and then early adopters, and watch people. Those messages tend to trickle through crowds in a predictable way, and using those, the time span of how long does that actually take, for those trades to take place. We have a bad earnings call, we have an hour, a day, or whatever it is before the message is fully flushed through the market, and going, yeah, I can theoretically do that high speed trading and execute trades. They use the word terrifying, and cool. I've got those. When you were implementing it, which ones did they try to, I mean, I'm sure you tried many to kind of, how do you maximize the usefulness of that data, right? Like the different spans. You mentioned earlier, we had a day, we had a week, we had a month. How quickly did those kind of dissipate? And was there kind of a Goldilocks zone for a window that was like more reliable than others?
For sentiment data, in the way that we gathered it, it tended to be a fairly short-term signal. It was good on the order of a day to maybe 3 days is where you had most of the juice, and then it would tend to decay after that. And that was unique to the type of data that we were getting. And if we had asked different kinds of questions, it could have been different. But so there's so many variables. But if you hold everything constant to our widget, asking them about those timeframes, most people would give us data for a day. Most people's sort of, trading impulse happened on a day. I mean, a lot of people are not that careful. I'm thinking about it for 5 weeks or whatever. They came on today and they were going to trade, and this is how they're feeling now. It's kind of like the weather in a way. The weather is very hard to predict, but right this minute, if you look outside, it's raining or not. You're better than the weatherman. I mean, the weatherman says on my phone, it's raining. I'm like, it's not raining, So my data's better. My information's better for right this second. But the further away you get from the second, sort of it falls off how accurate you are, right? And that's kind of the same with this kind of sentiment information. And because of that, even though we performed very well, we did end up starting a hedge fund, and that fund did rank in the top 10 in 2018. But we weren't trading, hundreds of billions of dollars or anything like that. We were every trading strategy. Another thing I learned on Wall Street: every trading strategy has a capacity, how much you can trade before the edge starts going away. And the number one thing that makes your edge go away is you could call it getting too greedy, but you're basically trying to put too much money on a trade. And so you have market impact. Market impact is your enemy. And so the shorter the time horizon and the fewer number of names, or the less market cap that you're trying to put the trade on, the less capacity your strategy has. So if you have signals on there's like 2,000 major stocks on US exchanges that are sort of meaningful. I mean, there's more than that. It's like 20,000 or something, but almost all of the actions in the first 2,000. So you can basically ignore from 2001 down to 20,000 because they're so small. You're talking penny stocks and different things like that. It's not, you can't really put any money on those. You instantly move the price, or you move it very quickly. Even in the 2000, you start moving those a lot quicker than you think. Even if you're a small guy like we, $10 million to put in it or something, it's going to be moving it. So it's really the top 50 by market cap are the ones that you can put money on. And everybody is trying to get an edge on those. So it's very hard to get an edge on those. So the easier ones to get an edge on are the neglected ones that the analysts don't care about because it's too small for me to go listen to the earnings call, and there's not as much information. And so there's any information whatsoever represents a larger informational edge. We're talking about stock stuff. We're getting a little off collective intelligence, but if your audience is interested, I can tell you, after 14 years doing this and maybe more, there are only 3 ways that I understand to make money reliably in the stock market. 2 of them have to do with information. One of them is illegal. I guess there's more than one that are illegal, but insider trading, why is that illegal? Because you have information that nobody else has. And guess what? Information is your edge. It's the number one edge. And if you have information that no one else can have, you're going to have an edge, but that's illegal. So you can't do that, and you shouldn't be able to do that. So then it comes down to, can you get information legally that other people are either ignoring, or they don't have, or they're not processing it the same way you process it, right? It's still an informational edge. So I'll give you an example. We did it the hard way, I think. Like when I look at how many moving parts we had and the team and how much exhausting work that was to keep the whole thing running, we had all these moving parts. We had the partners coming in. We had to make sure they were happy. We had to serve their customers. We could never have any downtime. If you go down on TD Ameritrade for 5 minutes, you're done. They're done with you. They never want that to happen. So that's a level of reliability and programming and everything. So we did everything. We didn't just process data like most hedge funds. We actually went and collected the data and dealt with all those things as a small company from multiple sources. And we had to keep it really high reliability. And then we had to do all the simulation and back testing and stuff that quant funds do on it to figure out where the juice was in our data. And then we had to do all the stuff that quant funds do on money raising and trying to get investors. I mean, there were so many moving pieces. It was hard with a small team. And that's another reason why people said, what are you doing? Like a smarter way would have been to focus on one thing. Like we just collect the data and sell it, and we don't worry about managing money or anything like that. We let, these big hedge funds do that and they just pay us. That would be simpler, right? Yeah. Or we just make the widget and somebody else uses our widget to collect the data. But we were doing it all, soup to nuts, because we just didn't know any better. And we kind of had the big dream of we wanted to prove that the retail guy could beat the big guys. And the only way we knew to do it was to build out the whole thing. So that's what we did.
I think I'm making that mistake right now. You just made me feel.
Sorry, I don't mean to rain on your parade as my advisor rained on mine, but I think it's helpful to take a step back and say, where's my core competency and where's the most effective piece? Because it is possible to do so much that even if you're right, just the sheer weight of it can cause you to not succeed, right? So you have to be careful about that.
Yeah, no, it's part of the founder's disease, right? I know the feeling when you're especially on this using data to try to predict something and prove it. And oftentimes you're like, there's no way I can do it. Like no one else is going to do it right. I know how to do it. Let's do it. And then before you know it, you're like, holy crap, that was I'm eating an elephant.
Well, and I think founders by nature are optimistic. If we weren't optimistic, we would not do it. We would do what everyone else did and, work for a paycheck or, go take a vacation or something.
I've come to the conclusion at this point that entrepreneurship is closer to a mental illness than anything else, where people go like, I'm an entrepreneur. I'm like, cool, I am, but only because I can't do anything else. So one of those things I have to do. I don't choose to do. So,
and people would say that about writing or art or lots of things. Yeah. So we're not alone.
Yep. I mean, it's interesting because we follow a lot of the same data. We use a lot of information in our business. My company's Wrench AI, and it does a lot of like behavioral analysis on people, segmentation. And again, its job is to like help you find who to talk to, what to say, and how to say it type stuff. And oftentimes one of the reasons that we were doing that originally was tied to equity crowdfunding. And it was like people would pay us and they'd say, hey, you need to go find us investors. And I'd go, we need to go find people who are comfortable investing and simultaneously know enough about this specific fundraise to be willing to actually participate and then throw money into it. Those are two very difficult signals to find simultaneously, right? Accredited level investors that are also informed on whatever you're offering. And it was weird stuff, like everything from like fundraising real estate on stadiums to software, widgets, consumer products and stuff like that. But one of the things that we found that for us was just so cool and amazing was how powerful the behavioral and heuristic data from the digital exhaust from being online was, right? I mean, man, 1999, I'm sitting there, I'm going, okay, I was graduating high school right then. And I'm going, there was very, very, very little to work with, right? In terms of like, we have a public sphere. We have a public sphere now that's readily available. The spirit and signals from it, people are, for us, when they're saying, hey, help us figure out who to talk to and what to say. I mean, it's very easy for us to go out into the public market and go, cool, what are people saying? And can we figure out which ones of them we really do want to listen to? I found when you found it, were you ranking I mean, I'm sure you had to like compare basically, okay, here's our signal that is from this crowd. Simultaneously, what is its value before, after for firmographics, demographics, psychographics, other kind of types of data that it kind of competed with? Did you we oftentimes see that there's a data hierarchy associated with like specific predictions that tends to show up where we're going like the best we can find is usually behavior based.
Yeah. So the data, when we first started, our data
Mm-hmm.
was the best. I mean, we had hedge funds that are the most famous on the planet that could not get the data that we had.
Uh-huh.
And they are way more in fact, they laughed at us. We said, we've processed it. We go into the meeting, we've processed it, and here's how, on this little simulation of trading at the open, trading at the close, here's how much we made, and it's great. And they literally laughed and said, we would never trade it that way. But if you'll
Huh.
give us a sample to evaluate, we'll tell you if it's any good. And they would come back and they would pay us more than they ever paid for any data. I mean, millions
Huh.
of dollars for our data, because
Wow.
they said, and of course, they're very tough negotiators too.
Sure.
So it's
Yeah.
like we probably could have got more. I was not very sophisticated, but they sold themselves on it because that was their business, analyzing every data under the sun. But
Mm-hmm.
what I found is over time, and I think this is to your point of exhaust data and everything, there was a point in time when exhaust data and the idea of analyzing exhaust data was a new thing. Every
Mm-hmm.
major hedge fund is doing that. Every major quant fund is doing that. They're all onto it now. And the same with our data, sentiment data, and everything. Even the way that we collected it in the beginning, no one was doing it. We were the only guy, and we were the only guys with this data. And it was alpha rich. It was like a gold mine, like a rich vein, and they
Mm-hmm.
saw this ore that came in to evaluate, and they couldn't believe it, and they're like, my God, we got to get this, right? And that's partly why we didn't want to sell it, because we kind of thought it would be like that, but we didn't know. They had more power to analyze it than we could, right? They could do more with
Sure.
our data than we could. But over time, once we licensed it to a few people, the quality of the ore went down. Well, it's natural. You had all these big
Big.
multi-billion
Yeah.
dollar people throwing money. And as they throw money on it, it pushes it down. And so your edge goes and it starts shrinking. And we were like, wow, that's not good. And of course, we didn't know what they were doing, but it's just a natural way of things
Yeah.
in the money management world, and certainly in the quant world and in the data world. If you have an edge, it will not last forever. I think the average half-life of a hedge fund is like 3 years. So half of
Really.
them go out of business within 3 years. We lasted much longer than that, for almost, I guess we didn't start it immediately, but at least 10 years. So we beat the odds by a huge amount, but we essentially had one main data source, which we then were forced for cash reasons to sell. And so eventually
Mm-hmm.
the quality of it sort of decreased. So that's one thing. But I want to circle back because I left something out. I said there was just three ways to make money, and they all have to do with information. One
Yeah.
is an illegal category. The other
Sure.
is that you have this data that's legal, but other people don't have it. And I've just
Uh-huh.
finished explaining that edge will go away. It
Yeah.
always goes away. And how quickly it goes away depends on what you do. If you keep it to yourself, how easy it is for other people to do. Most hedge funds didn't want to go out and partner with TD Ameritrade to get what was beating people's heads. They loved that we would do all that work, but they weren't going to do it because they were
Yeah.
smarter. They said, that's not our business. So if it's hard to do, then your moat will last a little bit longer. But
Hmm.
here's what I figured out at the end of this whole thing, and maybe this will be helpful, although it sounds kind of boring. There's a book which you may have read, Reminiscences of a Stock Operator. Have you ever read it? It's a classic
Never heard
trading.
of
You
it.
should read it. It's
Okay.
the story of Jesse Livermore, who in the 1920s, was known as like the boy plunger. He started as a wee lad of 12 or something in bucket shops, writing stock prices on a blackboard before there were exchanges. And he grew into the most famous trader of his day. And he, rags to riches multiple times. And this book is basically a fictionalized account of his life. At the end of the book, and he did what we were doing, which is basically trading over short time horizons, getting information. He was looking at momentum and things like this and saying, okay, now get in, now get out, now get in, that kind of stuff, which is,
Mm-hmm.
what a lot of people are doing, day trading and everything. That is a really hard way to make a living. I would go so far as to say 90% plus of all those people who are day trading, they really have no informational edge. I mean, they're studying things
Sure.
about patterns and all that. There's no edge there. Everybody else can do the patterns. The AI can recognize those same patterns. You do not have an informational edge. If you don't know what your edge is and you cannot explain why no one else has it, you have no business trading
No one.
in my
Yeah.
book.
Yeah.
Okay. So here's the best informational edge, I think. And it's great for retail people. It's good for big hedge funds, but it really works for us. Um, It's Peter Lynch, and it's actually my Nobel Prize winning advisor said the same thing. I was talking to him about stock trading once, and he said, Craig, I had an experience. He used to fly to conferences all the time because his famous guys constantly going to global conferences to talk about AI and different things. And this was back in the day when Pittsburgh, which was Carnegie Mellon, US Air had their hub. So we'd always fly US Air out of there. He said, one day I got on US Air and I noticed the orange juice tasted different. And so I asked the flight attendant, what's with the orange juice? It tastes better. And the flight attendant said, oh yeah, we switched to a new supplier. So he said, when I got back, I looked up who the supplier was and I bought that stock. And you know what? I made money on it. Okay. So that little story is an encapsulation of an informational edge. It was public available, no insider trading. He was on the plane. He was just an observant person who noticed something. And it was something that he knew very well because he always flew US Air, right? If it was random, so he was able to baseline, if it had all the elements of what you need, and then he acted on it and it worked. So if you take that core idea and you expand it, in my case recently, so I've been doing AI for 40 years now, since the 80s. I look around me, most of the people in AI have no idea what they're doing. All of the commentators on CNBC, all this, it's a bubble, it's not a bubble. Oh my God, that's just someone's handing you money on a silver platter. Because if you really understand the field and you know more or less where it's going and you have that confidence, and that confidence comes only because you've put in all that time. It's been like your life's blood for 30 years. You can actually understand what's real and what's not. And you don't have to day trade and you don't have to trade in and out in a day. You can simply buy, hold on, let it bounce up and down and cash out a year from now or 2 years or 3 years. And that actually is the best way. And let me tell you all the advantages there. Number one, you're relying on an informational edge that is unique to you because it's your own knowledge and hard work and experience. Number two, who are you competing with? Got to know your competition. You're competing with big hedge funds. What is the weakness of the big hedge fund? A, they have to put a lot of money in so they move the market. You don't. That's a big advantage you have. B, they're impatient. Every quarter, I know because I ran a hedge fund. Every quarter they have to report to investors. They fear like anything having to have a quarter where they are underperforming the benchmark. They will do irrational things, even if they have all the information from $10 million worth of data sources that tell them they need to hold NVIDIA. If NVIDIA is going down and it's going to make their quarter look bad, they aren't going to do it because they have this other irrational pressure, which is their money is going to yank away from them and they will lose their fees. And so that works to your advantage. You don't have to be subject to that. You can be patient where they're impatient. You don't move the market where they move the market. You know one area very, very well. They don't know one area very, very well. They're doing everything. And yeah, they have specialists and analysts and all that, and they have AI, but they're looking for, everybody's looking for the short-term win or the quarter win or the day win or the 10-second win. You don't have to do that. You don't have to play that game at all. And boy, I'll tell you, it is a lot less stressful. And you know what? You can make a lot of money that way because you are relying on your own expertise and you're letting their strengths be weaknesses. The big money is a strength, but it's a weakness here because they can't move. They can't be nimble. They push the price. And the patience that you have, they can't be patient as you. So you got to know yourself. It's like Sun Tzu, right? Know yourself, know your enemy, and you need not fear the outcome of 1,000 battles. That's what this is. You got to understand who you're up against, which most people have no clue, and try to fight them in day trading. I mean, that's almost insanity, quite frankly, if you really understood what you're doing. But nobody understands. They're just following the YouTube thing or whatever.
That's clever. I want to know. I'm one of these where I'd almost I feel like I'd second guess myself. I'd go oh, you're almost talking about a little bit of an aha moment. Like going, man, my stupid brain is immediately going to how would I quantify the aha moment? How would I personally recognize it in my own? All right, cool. There it is. One of those where you're going it's really, really clever. I mean, what was it? I think it was Ron Popeil once said, look, every time you're standing in line, there's an insight there. There's either a business to be had or there's a stock to be bought, right? Where it's oh, people are people are standing in line. They are willing to exchange money to solve whatever problem this line is caused by. I've always loved those. Like anytime that you're frustrated and standing in line, it's like, okay, cool. That's a business idea. It's like, oh, here we go.
Well, and the other thing is you don't need 100 ideas. You just need 2 or 3 good ones. I mean, Charlie Munger was right about that. So in your case, if I were to just use the little bit I know about what you're doing, you have a background in crowdfunding and crowdsourcing. You understand that market really well. There's very few people, almost no retail traders understand it as well as you, and very few of the pros on Wall Street understand it as well as you. So if there's a company that goes public in that space, you would be able to evaluate much quicker and much more accurately, right?
Oh, yeah.
So all you need is 1 or 2.
Yep.
Right? You just need 1 or 2 that you know, and you say, I understand this, and nobody else really sees it yet. And that's it. You know, and you just wait. It's like Buffett says, you wait for your pitch, right? That's your pitch where it comes in your area of expertise. And then you just have to not screw it up. And how do you don't screw it up you're not going to screw it up by putting too much money in, because no matter how much you put in, unless you're way richer than the Wall Street guys, but if you're just of average wealth, if you put $1 million in or whatever, even, you're not going to move that market. You could put that in a reasonable amount of time without moving the price. So you don't have that handicap. The only other thing is if you defeat yourself as it bounces around, you say, oh, and you second guess and you get out. But if you don't do that, you don't defeat yourself, you go with what you know, and you don't have to put too much money in, you've got a winning setup compared to all the sophisticated competition and also the retail guys who don't know it. So that's the easy way to make money. And Jesse Livermore came to that same conclusion after an entire lifetime of day trading, which is in that book, which is why I recommended it. Here's a guy who lived it, rags to riches over and over, over and over. And I lived it too, but not as much as him. And at the end, he came to that. He's like, this getting in, getting out, trying to do momentum trades, trying to do that. It's a fool's errand, even for a guy like him who was as good as there was at that in his day. At the end, he said, no, you have to play the big trends. He's right.
You just gave me an idea.
Well, good. So how does this all apply to collective intelligence? This was an example, this trading thing. We did prove many minds are better than one. You have to process the information correctly. And if you think sort of theoretically about what we were asking people to do, we were asking them to do collaborative problem solving in a way. A poll is like a very simple type of problem. You know, you solve the problem by just taking one action, and then you get to see. It's like a one-step problem, right? It's not a complicated multi-step thing. But it was enough for me to understand, because my PhD was in problem solving. So I understood how the system that we built there could be extended very easily to multi-step problems, and also how the entities don't have to be human. They can be AI as well as humans. And once you understand that, you realize that a collection of AI agents and human agents working together can have this really high level of performance. And that's a better way for superintelligence. And that's great for making money. But more importantly, it's a much safer way. And that's because it's transparent. You can see each of the actions on the network, which we had talked about, I think, in the last one. That is essential, because in the hierarchy of things, making money is great, but humanity's survival is way more important. And almost everybody's focused on making money, mainly because they don't realize that there's really a risk. It seems like science fiction. But if you're like me or Jeff Hinton or anybody who's been in this field a long time, you know that risk is real, and we have to pay attention to it.
I agree. Well, and I think it's a better way to do the ultimate. The ultimate flex is dying with smile wrinkles on your face, right?
I love that.
That's the ultimate flex. So, one, that makes me happy because, again, it's the evolution of like, okay, this is, you do, you know, I think we've all come up with those like, hey, I have this good idea that would make money. And a big test of it is like, cool, but you're probably not going to be poor. So like to your point on like, hey, if I would have known it would have taken 14 years, it might have not done it because it made money, but it may not have been my absolute passion, which it sounds like you found. Like I see that you are forming some smile wrinkles. So that's a compliment.
I just hope not to die soon. I still want to go a few more years.
I don't know. You just keep it up. Just keep it up. It is always super, super fun to talk to you, Craig. I appreciate it very much so, sir. Thank you kindly.
Yeah, it's my pleasure. It's fun, and it's great to discover that we have a lot of the same interests and that you've been following how to analyze different forms of data and sentiment data. I mean, there's not that many people in the world who sort of really understand that the way that you do. So it's great.
Oh, well, thank you. I'll take that as a huge compliment. Thank you. I like to, oftentimes I just go, oh, well, I'm a little bit faster than a lot of the other people running from the bear. Hopefully I'll just stay 1 or 2 steps ahead, but awesome. Thank you. Once again, I appreciate it. Dr. Craig Kaplan, always a pleasure. Thank you.
Same here, Dan.
Cheers.